Happy to be here. I'm more on the dirty side of things with the investors. Not super into hard sciences, but trying to learn more about the DeSci ecosystem, and yeah, happy to be here. So a bit about me and where I work at. So I've been in crypto since 2017, says here, yeah, but started out as a kid in my bedroom trying to set up mining rigs and try to make a quick buck. And I've been working in crypto ventures since 21, a bit before the bull peak. And I'm mostly looking at the earliest stage projects, trying to find things that we can invest in around hackathons, like social media and all sorts of different resources. And in that time, I've reviewed around 3,000 startups or projects more generally. A bit more about DLab. So as the host mentioned here, we're a part of SOSV. I don't know if anyone heard about SOSV. Maybe a show of hands. Okay, that's okay. SOSV is a global multi-stage venture capital firm, kind of focusing on hard sciences and climate tech more recently. And they're operating a traditional cohort style model where it's like a accelerated style, helping startups from the early stage succeed. And then DLab was one of the verticals within SOSV that focused entirely on crypto and used that same network that SOSV had to help crypto startups. We, as DLab, about a year ago, decided to spin out of SOSV, more because, not that we didn't like them, we still like them a lot, but we realized the model that works for like some hard science problems, like with wet labs and hardware, doesn't really work super well in crypto, and we need to run something more bespoke. So we decided to spin out with the support of SOSV as our anchor LP. So DLab is a first check discovery Web3 fund. We've been focusing mostly on infrastructure and DeFi. Not because we're not interested into other stuff, but mostly because the partners have deep experience in those areas. So it was like a natural place to start. And yeah, we provide very hands-on support to startups, setting up weekly meetings, OKRs and KPIs, really trying to get like you from the zero, where you're like just hacking away during the weekend and like making something cool, to an actual business where you can raise subsequent rounds, et cetera, et cetera. And yeah, our standard check size is around 250K. And yeah, some areas of interest here, definitely not limited to this, but general stuff. And you can find the website here. So a bit more on this topic. I was going to do like traditional funding style, but with a touch on how to do that in the bear market and how to actually raise capital when there's no capital to deploy. So looking at some data here just for context, you can see, so the top line is the data from PitchBook, that venture capital funds raised $10 billion in Q1 of 2022, and then raised sub $500 million in Q1 23. So a major dip in the amount of funding available in the space, and this is just for crypto. And you can also see that reflected on the funding below. So how the venture capital actually works, and I think it's important to understand that when you're trying to raise money from such a firm. Maybe I should step away from the... So it's important to understand that venture capital, pretty much, we're fundraising ourselves. We go to LPs, which are institutional investors, funds of funds, people with capital that look to deploy, and we want them to invest in us so we can deploy capital into promising startups, right? The problem with crypto, and in general the last environment, is that you have to deploy that capital within a year or two, and you're going to want to see some investments within, some returns within 5 years. And that whole model kind of dried up with a bear market and everything, so it's kind of hard at this point to raise money for funds. So a lot of the funds that still have money and are operating raised the funds before and still have some capital lying on, but the funding in general has dried up, making this like very hard conditions. a bit more on like how early stage investing works. So in general, it's all about the people. And we like to talk a deal out about this kind of matrix here, about a strong team and missing the a mediocre team down below, and a strong idea and a weak idea. So a strong team with like a mediocre idea could always pivot and make something else. So we want to back the strong founders. But if idea is great, but the team is kind of mediocre, it doesn't lacks cohesion or stuff like that, they can mess it up. So we generally want to invest in strong founders. And then kind of here are qualities we look for. And obviously these are all just criteria that we use at Deal Lab, not necessarily for every early stage fund, but we've worked with a bunch of other investors. We have a couple of syndicates ourselves, and this is kind of the themes that people at this stage look for. So a strong technical team is a key, and then complementing founders to each other. So if you have a strong technical founder, it's good to have someone with a good grasp of the business side of things, or the market side of things, kind of complementing each other, because at early stages, it's just a few of you, and you need some complementing skills. And then ability to ship is important. Too many times, especially in some of the more DeSci adjacent fields, we've seen founders that are super sharp, but they're not shipping super well. And when you're not shipping, our 250K check is only going to let you somewhere, and you need to raise subsequent money or turn a profit or something to stay afloat. So that's another important part. Pie chart here, kind of how we value this. So fundraising in bear market, there's a couple of key differences, and the obvious one is valuations. Seeing much lower valuations. 2 years ago, you could be two guys with a deck raising at a 20 million valuation pretty easily from A16Z and people like that. Not anymore, often, it still happens sometimes. And then relationships and traction are kind of the things that'll go into it. So here I don't know if anyone has seen this, but it's a good cheat sheet I think it's up to date still, Tuesday, with the valuations we've been seeing at, and this kind of correlates to what we've seen at Deal Lab, what we've seen from our syndicate partners, that these are kind of the markets. So you can see at a pre-seed round, we're seeing a much lower valuations, kind of cycling 5 to 7 to 10 million valuation. And you can see also the cash raised, and that's important to consider is how much cash you're trying to raise and what stage you want to be in. I'll share this later, I believe. There might be a way, so you don't need to, So talking about the relationships, so this is what matters so much more in the bear market than the bull market. Bull market, investors are going to chase you, they're going to run after you and try to give you term sheets while you're in the toilet. And the bear market, you kind of need to build those relationships yourself. So it's kind of like a business development side. Top-down numbers matter, and the more investors you talk to, the higher percentage you're going to turn into potential investments. So kind of treat it as a biz dev side of thing, make a CRM with investors. It's a numbers game at the end of the day. And then you want to identify firms that have clear ideas and teams that match what you want to build. So for example, if you're interested in tokenomics side of things, you're not gonna talk to investors that are oh, we don't want to see a token. Sometimes they might invest, but that's usually a good first thing that investor will say no to, is you haven't done a research on them, you send them a deck, and they're what, why? In cases like this, it might be helpful to get a warm intro. Founders' warm intro are usually the best. If you have a founder friend that has good connections with investors, it's totally worth going through that route. Also, your existing investors, your friends, anyone that has potential to give you a warm intro, because I, for example, see about, let's say, like 20 inbounds a day of just people randomly cold messaging me a deck or something, and it's hard. Like, we're all people too, and venture capitalists are lazy especially. They don't want to look through all of it. So if I'm just going to see your deck in my Telegram DMs, I'm going to scroll through it and I'm like, huh, okay, cool, and leave for later. Because I get a lot of stuff. And yeah, it's a long game. Someone said it recently, and I think I like it quite a lot, that finding an investor, especially early stage investor, is like finding a spouse. Because it's a long relationship. You want that initial investor on your cap table for the next 5 to 10 years, and you want them to help you grow where you want to be. So in general, you want to find someone that aligns with you and that you can work with to achieve your goals. So moving on, so traction, again, is a big difference in terms of bear market. I know it's hard for some projects, especially in the DeSci space, like to show traction, especially like if you're working with academia or big institutions, like you're not gonna convert a sale within a month or two. It's a much longer sales cycle. But the way you can show that is you can have, for example, a good biz dev pipeline, like a CRM system where you show the investors that you're working on that and you have a clear plan. So you're not just like, hey, invest in me and then I'll get Harvard Medical School to buy X amount of IP tokens from us. You gotta have a more clear plan. And in general, yeah, bury investors with data. That's I think one of the biggest tips I could give. The more data investors have, easier for them. Especially, again, investors are lazy. They don't want to do the research on their own. So if you spoon feed them the data and everything, it makes it easier to look at you. And then, yeah, the question, like, in the bear market especially, like, your early stage investors are not going to be super high checks. It's going to give you, like, a certain amount of runway. And you got to prove, like, okay, if I invest into your startup right now, and I give you 250K for 18 months of runway, what are you going to do by then? Like, are you going to make some money? Are you going to get some revenue? Are you going to be able to raise a subsequent round? How are you going to raise that subsequent round? I'm telling you all of this just to understand like the investment side of the process, because I think that's the easiest way to figure out how to pitch to investors is to understand what investors want. But yeah, think about that, like, will you be able to make a revenue or stuff like that. And then, yeah, some stuff on the deck. I mean, there's bazillion advices out there on how to make a good deck, so I'm not gonna try to reinvent the wheel here, but some of the stuff we've been seeing. So in general, your deck should be a short story that will get you in front of the investors. You send the deck, it's like 10 pages long. I look through it, I'm like, this seems cool, I wanna meet these guys. I wanna do a more in-depth research on this. So your deck should really be kind of like your mini profile that will get you in front of the people. And then, yeah, excuse me. Kind of like you want to focus on your team, obviously. As I said early on, team is all that matters. You want to focus on the problem you're solving and why this market. Like, why are you super interested in this? What's your kind of like relation to this? And then all of this kind of ties together into it. Like the team, the motivation for the team comes into the market, and then like the problem you're solving. Usually, successful startups we've seen, they're solving a problem that's personal to them in some way. And it doesn't necessarily mean that you have to solve this problem because your mother was dying and like, no, it's not a sad story, but just some personal connection helps you show the investors why you care and that you're not gonna, run away after 3 years of cashing out. And yeah, kind of an anecdote. Yeah, this morning there was a fire alarm in my hotel, so if the house is burning, show how your startup is the one extinguishing it. And yeah, in general, I like the decks that are simple. I don't like super long like animations and stuff. Yeah, that's cool, but really it often is just a distraction. And I'm not going to be impressed by your graphic design skills or paying a Fiverr designer to do an animation. And yeah, constantly iterate and adapt the decks as you're talking to the investors. You're going to get feedback. You might not get a call. You might get on a call and you do a live pitch with a deck and you don't move forward. You stay at that first call, they say no. So you want to figure out what went wrong and what can you iterate. Because like investing and fundraising is also a process and you want to constantly improve onto that. And I think one of the most important things here, don't give up. It's probably the hardest time to raise money in the last almost 15 years, I'd say. There was like a peak around 2009, you could do 2010. And obviously 2010s were super nice in terms of raising. But yeah, it's a very hard time, but it's still possible. There's still venture capital being deployed, so you want to keep at it. And I think a good tip also is keep going until you get a no. Lots of investors will just keep you on hold. They'll be like, oh cool, let me know when X is happening, or they're not even going to read your message. And you want to keep pinging them until they say no. Even then, you might want to still like send them monthly investor updates, stuff like that. But it's always important to keep that conversation going. And yeah, one event can trigger the rest. So, you know, usually, especially right now in seed rounds, lots of funds are not looking to lead per se, and they're looking for a more reputable fund to come in and say, we're leading this round. And they're like, oh, okay, we'll join. So, you know, nailing that one lead can really start the process going, and then suddenly you're going from, you know, 1 month of runway to a whole new deal. And yeah, most importantly, in the bear market, like, focus on the product, build something that people want to use, and other things will follow. And yeah, that's about it. Here's my info, and if you want to ask any questions, I'm open for that. Thank you.
Thanks, Aleksa. Super interesting. Lots of points to learn there. I've noted some down for when I'll be fundraising one day. Yeah. Do we have any questions from the audience to Aleksa this morning? Anyone looking to fundraise and needs some more input? Or a warm intro right here?
You can also just message me. Or...
Yeah, go for it.
Sorry? So in terms of, if everyone heard the question, it was the percent of the projects that that went profitable that I reviewed. So the projects I reviewed, they're mostly from hackathons, so because that's kind of our entry point. We like to be the first money in. So not a lot of projects there even turn out to be good projects, but there's definitely, I don't have the exact percentages there, but I can talk about our investments that we did earlier, not in the last 2 years. There's 4 out of 20 that are profitable, and bear in mind we just started like 4 years ago, so out of those, yeah. Does that answer your question? Sorry, I don't have the exact data on the hackathon stuff.
Okay, once again, round of applause for Aleksa. Thank you.